Hey, so do you put 20% down or don't you? Because PMI is real, and you're probably asking yourself, where should we go in what direction if you're buying a house? My name is Dan Gandee. I am a broker in Oregon at eXp Realty, and I wanted to shoot this video because ultimately you need to talk to your mortgage loan originator or your mortgage broker and get the best advice possible. But I wanted to bring some advice up on how to navigate this question and really ultimately put yourself in the best situation possible when buying a home. When understanding PMI and understanding how much money to put down, first you got to look at your financial blueprint and your financial status of where you are in your life and how much money do you currently have available or down to put on a house, right? You don't want to go house broke. And I want to talk about that for a second because a lot of people want to put money into things like furniture, appliances, all the little things that come up. And you just never want to put yourself in a situation where you don't have the money to do those things. And I remember when I bought my first house, it didn't come with window coverings. And then I had to go to Lowe's and order a bunch of custom window coverings and ended up spending like $2,000 or $3,000, guys. And I wasn't house broke at the time, but I just wanted to tell you, it opened my eyes to understanding that you want to put yourself in a situation that matches your financial blueprint of who you are and what you can afford, what your affordability is, what your liquidity is, okay? So that's the first thing you need to ask yourself. The second thing you need to ask yourself is, what type of loan am I using? And how much would PMI cost me over a specific time period that I think I could forecast of owning this property? If you put 10 to 15% down, you usually hit an 80-20 equity position within 2 to 3 years, maybe 4 years. If you put a little bit down, like 0 to 3 to 5%, it may take you 5, 10, 15 years to get your PMI lifted from your loan. So ultimately, what type of loan type you're using and how much you're going to put down and what you think you'll hit that 80-20 equity position or loan to value, and understanding how much money you really want to put into the property, right? So in that, taking calculations of understanding, if I'm going to hold on to the property 5 years and I'm not going to get to an 80-20 equity position, how much is that PMI going to cost me over that 5 years? So just call your mortgage broker, ask them how much the PMI on average is going to be, and then multiply it by 60 months, and that's how much money you're going to lose as an expense. It's not going to go through towards equity. It's like interest, right? It's the cost of doing business. And then you're going to need to ask yourself, well, how much more money would I need to put down in order to alleviate that PMI, okay? So if you need to put, say, $50,000 extra down to not pay PMI, but you're only going to pay $5,000 or $6,000 in PMI before you go to sell the property or refinance, it probably makes sense to just add that and chalk it up as a loss, as an expense you're going to pay, right? Because you don't want to empty your bank account because you have other plans for that money. And I want to parlay that into this other concept of, do you use the money that you wouldn't put into the down payment or equity into your house to invest in other things that have a higher trajectory or velocity of return? And what I mean by that is, if you're going to spend all of your money to get to that 20% down, but you could have used, say, 10 or 15% of that money and only put 5% down, but investing it in things that yield higher than the appreciation in your current market, depending on where the real estate market is and when you're watching this, that you put yourself in a good trajectory, right, to make money off the money that you currently have on hand, the liquidity, versus dumping it into an asset. And if the real estate market slows down or there's minimal appreciation, typically that's about 2 to 3% a year. In most average markets, upwards to 10, 15%, maybe 20% in a fast-moving market or a growth market. So that's another question you really got to ask yourself. What else would I do with this money if I don't put it into the house? Okay. Another thing to really ask yourself is, what is the condition of that property and how much updating and repairs do I want to do to increase its value? Okay. okay? And I call this a slow flip or live-in flip scenario, right? You're using the money that you didn't put in the down payment on things that are going to raise the value of the house, and you may, after 2 years, do a cash out refinance or just do a refinance in general and have it reappraised, and that may build you wealth and more equity position just by being able to use and leverage that money, right? It ultimately comes down to why I tell investors don't pay 100% cash for investment properties if you have the financial ability to use somebody else's money to build trajectory and leverage, right? So if you're going to do any repairs or updatings and the property needs those things to get to the next level of value, you probably don't want to put that huge down payment down, and you probably will pay PMI, and that appreciation gain or that equity gain that you're going to have from doing those updates and making those repairs is probably going to offset the cost of doing business, which is having PMI. Okay, I try to break it down as clear as possible. And in that same context, I want to talk about cash on cash return. I deal with this a lot with investment properties, but it's really how much money did I have to put down in order to acquire that asset, to hold it, including closing costs and everything else, and then how much money does that asset return me? Well, when you have a rental property, you have net operating income, you have cash flow, and you have tax depreciation write-off that are all things that are working in your favor. When it's your primary residence, you have appreciation, and you may have some write-offs with taxes, but really what I'm getting at is if a house is appreciating at say 3 to 4%, but you're not getting cash return on that investment until you sell, you kind of have to look at it like a bank account and what that cash on cash return is going to be over the period of which you want to hold that asset until you exit. Okay? And you should really look at owning a house for right around 3 years at a minimum, upwards to 5 to 10 years if you really want to see that gain in that investment. So I'm saying all this because the cash on cash return, the less money you put down, right? And the more money you have to make repairs and updates, and then you go and get it reappraised or you refinance it in 2 to 3 years once that loan is starting the season. Now your cash on cash return is better if you're solely looking at equity that has been built. If this was an investment conversation, we'd be having a completely different conversation. But when it comes to primary residences, you have to understand it with those eyes, right? Last but not least, we've talked about using the money that you're not going to put into a 20% down payment for better velocity in your investments, using that money to make updates and upgrades. We've talked about the cost analysis approach of how much more is it going to take out of liquid assets to get to 20% versus how long would it take me to burn through that entire money, paying that PMI in how many months. And we really looked at this from an investment standpoint of cash on cash return. The last thing I wanted to really let everyone know is that a good percentage of people don't live in the same house that they originally bought 10 to 15, 20 years ago. Times have changed. Society has changed. People get bored. People's jobs relocate. You may downsize. You may not like the schools your kids are going to. Whatever it is, right? The percentage of people who are not living in homes for more than 10 to 15 years is way higher, guys. Way higher than it has ever been before, ever. So you ultimately have to look at your inner personality, right? I got a lot of buyers that work with me and they say, oh, this is a forever home. We're going to live this forever. And I would say that literally about 50 to 60% of the people would probably call me back in 5 to 6 years and say, hey, we want to relist our property. We're looking for something bigger or we're moving. So times have changed. And I want you to understand that if you know you're going to live in that house for years, it's the dream home. Unless something crazy changes, you work locally, your business is ingrained locally, you're probably better to pay that 20% down and knock that PMI off because you know over the long term that wasn't even a cost involved in the equation, right? It's just not a bottom line. It's the cost you could have avoided. And the same conversation goes into paying down points, right? If you know that house is the one that's going to live in for 10, 15, 20 years, and you have the cash, put 20% down and also buy down your points. Get the lowest interest rate possible, because your cost to you over the long term is going to be far less, guys. You'll shave off 3, 4, 5 years at a minimum by doing those adjustments and really understanding the longevity of all of this. Now, I don't know the fiduciary responsibilities of lenders, but I will tell you this. Some of them will ask the question, well, how long are you planning on owning this property? They know as well as I know that most people are in a position to sell their house, like I said, every 3 to 6, 7 years. So if they try to convince you to buy down the loan, it doesn't make sense. You're spending cash on cash right up from the beginning. That doesn't make sense to your scenario and what you want to do. So if you don't know the answer to that question, you need to evaluate all those other things I talked to you about, so that you can make a better decision based upon your immediate needs versus your long-term needs, okay? And that's really what I try to break this down. If you have any questions about PMI and you live in the Eugene, Springfield, or anywhere in Oregon, I got 2 amazing lenders that I can refer you to that can answer any questions, guys. If you live anywhere else in the United States and you want to find a really great real estate broker that can help you, I will personally vet them and give you a referral. I will call them, ask them questions, screen them, and make sure that the experience that you have is what I at least like to set as the minimum barrier or bar to having a good home buying or home selling experience, right? And ultimately, what I like to say is that if anybody has any questions, my contact information is below. If it's lender related or mortgage related, I'm going to refer you out to somebody. But real estate, investments, any of my professional opinions that I like to share on this channel, reach out. I'm not shy. I am more than happy to help you no matter which way you have a question. So please like, subscribe, and follow me